Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Earnest. You ready? Let's dive in.
Chris, I'm so happy to have you back. Thanks for being on the show.
Well, thanks for having me back. Being the first repeat guest is quite an honor. So pleasure.
Yes, that is correct. Chris is the first repeat guest. I was looking it up before we started recording. I believe your last episode was episode 22. People should go back to it. And it was released May 1st, May 1st, 2 years ago, 2024. So as I was going back and looking, last episode that you were on, the market was very different. You talked a lot about behavioral finance, CapRock, multifamily offices, and manager selection. Just curious, now that you're in a new seat at Aksia, what's changed in the market, and why the move?
A lot has changed. I mean, 2 years goes by in a blink, but I'll just give kind of like the background for the move and sort of like what we do and what we kind of see and where, I think a lot of this is evolving in wealth. It's happening really rapidly, like the level of sophistication and changes that are occurring in terms of like product structure and what's happening in wealth is just going so fast. So 2 years ago, when we last caught up, I was at CapRock, multifamily office, was looking at Aksia's credit product. And so I've known Aksia for 15, 20 years from the institutional world, really well regarded in terms of deep research across private markets. Anyway, I looked at the product. We had a conversation where I'd known a lot of people here, and I saw the roadmap that was coming in terms of other vehicles and products coming to market, and just sort of this view of how Aksia could be a great value-added partner to wealth. And so joined in sort of this strategist sort of content role here. And, since that time, we've come to market with 2 other products. We've got a roadmap behind that. And I think well positioned to sort of be that provider of value-added research content and asset management services across private markets to the wealth channel.
To level set for our audience, could you just give the background on
Sure.
Aksia?
Yeah, happy to. I'll kind of spare the commercial, but so Aksia's been around for 20 years, and our DNA would be as a institutional investment consultant / advisory firm. I think there's sort of a pejorative around consultant. That's unfair. We can talk about sort of where I think we have, big advantages, and people like us have big advantages. But really today we're $380 billion investment advisory specialist focused on 4 verticals of private markets. And that's all we do. It's private markets / alternatives, private equity, private credit, real estate, real assets, and hedge funds. And historically, we have been a partner to big institutions. So we help them in sort of 3 different ways: research, advisory, discretionary, right? Real simple. We have a big research platform. You can access that, do it yourself. We help you as an advisor and outsource sort of extension of your staff, or we can be an asset manager. And so increasingly we've done more of that, managing just portfolios for clients across those verticals. And then that's the natural evolution of kind of that approach to wealth, to building portfolios in private equity, private credit, et cetera, and then making it accessible to wealth via those wrappers. So today that business is called about $1.5 billion with 3 different products, and it's growing really rapidly. I think like we're very well positioned to take what our firm is really founded. It is deep skeptical kind of research and thorough analytics. 2007, we released a diligence report on Madoff. Obviously that was huge back then, and it sort of landed our credentials as, really being skeptical and thorough research. So that's what we are today. Yeah. And it's a great seat to be in. So I can talk more about the products, but I thought maybe we'd go wherever makes sense for you.
Can you share with us something we should be skeptical about?
Today? So if we want to just jump right into, I think where I would see skepticism, or at least being concerned about some of the valuations, is AI for sure. Like there's no question it is a big technology disruption that is occurring. But you can think about bubbles. Like, what's a bubble? Like, we can get into the big, epistemology behind what a bubble is. It means inflated valuations. You can have a bubble without true technological disruption occurring. It's very rare that you have disruption occurring without a bubble, right? Because that's the whole kind of Gartner hype cycle. If you really have things that are changing the economy or changing the way things are built and made, it's going to get overinflated. So I think at the same time, you can have both expectations that are probably too optimistic and too pessimistic occurring at the same time, right? And that might be happening what's right now. We see pockets of excessive valuation in certain areas, and I think there's capital formation there that's going to lead to capital destruction in the long run. But at the same time, I don't think we fully appreciate like the diffuse impact that it's having across the economy, right? Like, I think it's really nuanced. It's not, we joked about this in the conversation before the call, but it's not legacy SaaS goes boom. Like, that's way too simplistic. And in fact, there's areas where things are being disrupted that it's not SaaS, it's services, it's small businesses. And I don't think that's being appreciated. So it's nuanced, but I think understanding where there's opportunity, and frankly, it's probably, the time to invest was a year ago or 2 years ago, and now a lot of those valuations are really stretched. So yeah, if I were to zoom out and just look at our team, like, we're probably skeptical in all of our asset classes as far as a lot of the big valuations that we're seeing. So we have, yes, real assets. Do you want to own data centers, or do you want to own and invest in maybe the power infrastructure behind those data centers? Do you want to be a lender to corporate credit risk? Because a lot of those off-takers, it's corporate credit risk, and maybe that's not priced adequately to other areas of the credit market. So that's where I would say, like, right now, it's probably a time to be a little bit more skeptical when everybody else has sort of FOMO.
Chris, you kind of got into what I was going to follow up with, is how the bubble of AI is impacting your other asset classes. But you kind of mentioned it also with kind of the real assets and that next layer of figuring out, all right, what is undervalued that's going to be very needed in the next 3 to 5, 10 years. When people think of kind of venture and AI, they think of, everything's just overvalued. Do you think there are some pockets that are being undervalued today? Maybe it's, in SaaS companies and certain types, or growth equity companies today. Where are you seeing kind of the opportunity?
So yeah, if I would look at, let's stick with SaaS. So we've done a lot of research, and we've invested in SaaS, both in the credit side as a lender and in private equity. Right? If you think of where there's risk in SaaS, and maybe that leads into where there's opportunity. So over the last, call it 8-9 years, roughly 20-25% of private equity has gone into software businesses. It's been very hot in the private equity side, and venture capital aside. A lot of that was deployed in, call it 2019, 20, and 21. So that sort of 3-year vintage was, call it maybe 30% of total capital deployment. And it's maybe a third of what's total outstanding. So you got this little pocket there. Why is that at greater risk? A couple of reasons. The 3 main ones being that was done when rates went to zero, and they really bottomed out in like 2020, 2021. That leads to valuations, right, that were peak valuations kind of in that 21 peak. So those businesses were highly capitalized. Some of them were highly levered based on ARR with rates at zero. And then rates reset. And so now they see their cost of capital. It's the 21, 22 vintage that was expecting to be borrowing at like 6, and they wound up borrowing at 11. And then that's also the period where, Chat GPT kind of came out. I think it was November 22. So really that pre-22 stuff, it had a mix of economic conditions that sets that most at risk of being disrupted. Stuff since then has actually done very well. Like a lot of 2024, we see pretty strong EBITDA growth in like our SaaS businesses and software businesses, because those are AI native. And so it's benefiting from those things. Like even those earlier ones, like if we look at what business characteristics make them durable versus at risk, I think SaaS that has, proprietary data, customer, installed customer base, maybe with sensitive customer data, and it has this intersection of functional workflows with or horizontal workflows with functional industry specifics. Those are really like highly embedded. If you think about like Uber, no one uses Uber, right? Because like the UE is so cool. You use it because there's a real world network effect that's hard to just replicate. And so Like, will they use AI? Probably already are. I don't know. But like, that's not the differentiation. So there's a bunch of stuff out there that's like that I think will be fine. There's more bland, horizontal software that's like simple workflow stuff. That probably doesn't have a right to exist anymore. And again, you're seeing that in one of the big sort of PE hand the keys back to the lender scenarios right now, like where AI lets you do it yourself pretty good, or maybe better, even more customized than what exists off the shelf. Those businesses are at risk. And then like even the knock-on effects. Okay, so it probably means SaaS has to get better. SaaS has to get cheaper. Like if you can build it yourself versus buy it, why wouldn't you?
Now, this is a very cool example of how the work you're doing at Aksia is so research driven. Very cool to hear how AI is reshaping the companies and the software. What about diligence and even investment committee behavior?
It's very similar. Like you see the low-hanging fruits are where it makes, analysts more efficient. So maybe AI is going to replace junior analysts. Like that's where the lower value-added information service roles are going to be competed away probably, but it makes senior analysts, portfolio managers, way more efficient. So I mean, we have lots of different tools that we're using and investigating. I mean, we have subscriptions to, the enterprise stuff. And so it's helping in low-hanging fruit like, memos and synthesizing and aggregating data. One of the challenges in private markets is there's a lack of data ubiquity compared to public markets, right? So everybody in public markets have a right to all of the data in real time. That's why we have Reg FD and things like that. That's not the case in private markets. Information is still highly, highly asymmetrical, and you have to actually go out and get it. So a big part of the value add in private markets is going out and accessing all that information, which is still kind of manual. Like it sits behind right data rooms and NDAs and confidentiality agreements, and you have to pull it in and scrub it. So once you get that, you can use tools to then synthesize it and analyze it, be more efficient with that. So I think there's a longer runway, frankly, where still just a data advantage will accrue in private markets versus public markets. Public markets, you see hedge funds using, AI to come up with trading rules and to actually implement stuff as an agent. We don't see that in private markets, but I can give an example of a big private equity firm that has an AI agent on their committee. So this is a firm that has, 10 or 11 people on the committee, but this entity has a vote that counts like everyone else, obviously won't swing it, but it's fed the entire memo, it's fed the data room, all the information, and it comes to the committee vote with questions. So like, that's really cool. And what they have indicated is that it's always asking things that humans have not thought to ask. So it makes you smarter and brings a different perspective. So like we're seeing all these areas where, like I said, it is disrupting things. It is really impactful.
I love that. And it's because I think we're in this transitionary period where a lot of fund managers across different asset classes are tinkering with the tools, which I think is really important. And you should look for individuals who are constantly tinkering. But within that, you have to have parameters that allow you to, one, not tinker too much. You can literally create everything and anything that you think you need for an internal tool. And two, that are congruent with helping you become a better investor for whatever you're really good at. And so from that point, has like the incorporation of AI as like another kind of table stake tool in the toolkit, has it changed things that you look for in the criteria of a fund manager or for with your team?
I don't think it's fundamentally changed things to that extent. It just makes you more efficient in how you're prosecuting the process and accessing some of the information. I mean, it's good at pattern recognition. I mean, maybe one area that it has changed is you are now asking GPs and asset managers about how they're implementing AI and how they use it. So examples like the one I just gave on the investment committee, those are now things that people in due diligence are asking about. I think it'll only continue to evolve. We touched briefly on this too about the use case of like behavioral coaching and like an analyst in an intro meeting with a GP. There can be tools that can be created that already have, like historically that was more of an apprenticeship process. You sat through lots of meetings, you learned how to ask the questions based upon pattern recognition of those meetings or what the GP does and what you should be asking similar GPs. Well, now you can create a tool that can actually coach somebody in real time. You know, you ask this, follow up with this, etc. And so I think there's lots of ways where it theoretically could make the whole process better. And we are starting to see things like that. There's AI-based behavioral coaching tools in other areas, like Minerva is doing things for senior executives at portfolio companies, etc. So I think we'll see some of these applications. It's still early days.
I had a question that that I just kind of came to my mind when you first were introducing and talking about your new seat, and you used a word called like not only research but like content. And content is something that's becoming bigger for allocators as they discern for net new relationships. What are you doing? I was talking to an LP yesterday that was saying, hey, we look at also what are you doing outside of being an investor in VC to help you become more of a founder magnet, to help you get those insights. Because as you mentioned before, Chris, like data is something that can still be proprietary. Sourcing can't really, but like in knowing about a company, but actually the specific information you know about companies and industries can be helpful. What's the role that content plays for an allocator, an advisory firm that's so important now?
I think, well, so from my seat, like part of my job is to leverage the research that we have and all the data across our teams. I mean, we have, 200, 250 people that are engaged in investment functions like day to day. That's what they do. They're meeting all the GPs, they're taking the notes, they're digging through the data rooms. And so that provides, with an incredible view and sort of going through that and having some insights and observations, like taking that and creating value added content for clients and investors. An example would just be like some recent research on credit risk. We talked a little bit about private credit. Is there an apocalypse happening there? We think that that's wildly overdone, but we have some great research that we've distilled and provided to our clients to say, here's how to think about risk in your portfolios, and here's some sort of baselines that you can use. So I think, really good value added content has something that's an applied takeaway, but increasingly, this is a thought that's occurred to me. I think GPs and asset managers need to be creating content in various media, right? That is what their LPs want to consume it. So it's less and less about a PDF or a white paper that you can just shoot over to them in an email, and more about interactive data, whether that's data visualization, charts that are sort of live in real time and people can, move things around and sort of look at stuff. I think that is becoming much, much more important. And that's still also early days.
Another very hot topic that you've been observing from this cool seat of sort of getting to pull from everybody's observations is around SPVs and like layering SPVs. Can you tell us what you're seeing there?
This has been a trend for several years. It's not new. I mean, when I was in my prior role, we saw it, we were sold on this. And then SPV technology, as you guys know, is like nothing new. It's perfectly fine when it's used. One of the problems is when we see what we call SPV sandwiches, where it's just layer upon layer upon layer, and you don't know, number one, what the underlying assets may actually be, but you certainly don't have great transparency into the layers of fees upon fees upon fees. And so
Chris, it reminds me.
Yeah, go ahead.
Chris, it reminds me of something that happened maybe in like 2007, 2008, when we just kept layering things and nobody knew what they had.
Yeah, exactly. And then you package it and sell it and repackage it and resell it. So
yeah,
it's very similar to the risk of what's happening with some of these, these smaller subscale, sub-institutional kind of SPVs that are out there. And I think they're they're selling into a desire to participate into this AI. And before that, it was, whatever was the hot opportunity set there. But I think there's a difference between, subscale has access to an SPV that they can repackage and sell and is going to go out and sell it, versus somebody that is actually driven by an investment thesis and then investing in that thesis and then providing access. Like, it sounds like a fine kind of a distinction, but it's actually really important. Like, one is, I'm going to sell whatever sells, and I'm going to package it in a way that is easy to sell. And I think people have had a hard time kind of distinguishing between the two because of those layers of complexity. So to me, it's about ensuring that your partner or provider or whoever you're working with has the ability to assess what's in there. I mean, in the worst case scenario, like, there's been fraud. It's not even what you think you're getting. But even if it's not, it could be some sort of a restricted stock or something that's not the common in what the underlying company, you hope it is, or it's an option or something like that. So yeah, that's one area where also we talked about being skeptical. I would be skeptical if somebody, comes to your room and says, I've got this great access because of my great network, and it's, one or two people that have only been doing this for 2 years.
Now we're going to take a quick break to speak with our sponsor.
All right, today as our special guest, we have Nick Cassin, who heads up Sidley's secondary practice. Nick has a ton of experience with fund liquidity transactions. He's focused on venture, but also PE, real estate. So any questions you have around continuation vehicles and LP and GP-led secondaries or tender offers, those are the things that his clients are coming for him to ask about. Welcome, Nick.
Thank you. Thank you, Alexa. It's great to be here with you.
So, Nick, you are known for secondaries in general, not just venture. Can you give us a picture of the full universe of secondaries that you're dealing with?
Sure. And that is really one of the aspects of my role here at Sidley that I enjoy most, and that is the breadth of asset classes that we deal with. I mean, as I mentioned, the transaction structure, whether it's the GP-led structure, the strip sale, or the LP trades, really can apply to all asset classes. And so currently I'm working on deals that involve data centers, deals that involve private credit portfolios, single asset GP-leds that involve credit rating agencies, multi-asset GP-leds involving real estate joint venture recapitalizations. And so it's really a huge breadth and then constantly interesting new and novel issues that we have to deal with depending on the underlying asset class and the specific regulatory concerns that those engender.
Well, in that case, I think our VC audience are quite lucky because a lot of these sort of liquidity options didn't originate in venture. They've come from PE, they've come from other asset classes. Are there any trends you're seeing where more venture GPs are implementing different strategies?
Yes. So it's definitely one of the upticks I've noticed in recent years, and that is venture participation in these transactions. I have on my desk right now transactions involving 3 different venture funds. One is an LP trade. The other is a GP-led where I am representing the new money. And the third is a GP-led where I'm representing the venture sponsor. And that in itself has raised some interesting conversations, in particular around the economics.
And for our allocators who are listening, I'd love to hear your perspective on why choose to work with Sidley.
Sure. So I think what Sidley offers and what is a differentiator is really the breadth and expertise that we have across not just secondaries, but private funds as a whole. I mean, I believe my colleague Shane, who leads our venture practice. We have a practice that focuses on GP stake transactions, which is obviously fits into the broader remit. We've got excellent fund finance capabilities, including anything relating to NAV loans, which are also a topic of high interest in the market. And so really, I would say it's the breadth of our expertise, but also the fact that we're very commercial. I mean, I've been in doing these types of transactions for 15, 20 years now, and so I've seen the touch points. I know what clients should care about, whether that be on the buy side or the sell side. And so what I pride myself in is being commercial and coming to an efficient and sensible and reasonable middle ground, probably faster than what some of my competitors are able to achieve.
A lot of real world experience.
Right.
Is there an example of something you're helping a client with right now that you could share with us?
Sure. So, on the venture side, I mentioned I'm working on a GPU-led representing the sponsor, and one of the items that comes up as part of these GPU-leds is the expectation by the new money coming in that the GP will continue to retain significant exposure to the continuation vehicle. The primary reason for that is to ensure alignment of interests. And so what the new money will usually require is that any existing investment that is being made through the fund with respect to the portfolio company at hand be rolled into the CV for that same portfolio company. But in addition, that any carried interest that's generated and that's crystallized as part of the CV sale also be rolled into the CV as an investment by the GP or GP affiliates. And so the discussion I'm having now is essentially working to have an exception made to that general rule so as to allow the GP sponsor to quote unquote clean up shop as part of this transaction and perhaps give certain senior investment professionals that are approaching retirement an exit opportunity and an ability to take money off the table, or to recut the economics as it relates to the CV carry waterfall, because there's no default that entitles the carry holders in the existing fund to those economics as it relates to the CV unless they have that specifically negotiated in their GP docs. It's such that often does become a topic of conversation when on the sponsor side and considering these transactions.
Well, it sounds like something that should also almost be expected, given that these transactions, these funds are stretching out to so many years.
Exactly.
That this would end up being a commonplace opportunity to put the new leadership at the helm.
Indeed, generational shift going on.
And now back to our LP interview.
Do you have any kind of checklist or major questions people should be asking? Because I've been surprised by, one, the activity and individuals who have claimed to be able to put together these SPVs. I think they've put together, but again, I don't know if they have access. There's a side note. There's one person who I was like, this is the dumbest thing you could do, that posted on X where she says she made more in her in one Anthropic SPV than she's ever made in her life or something like that. Not smart. But anyway, so you have people doing that. But do you have any kind of questions that people could ask if they're a family office? I've even heard pretty significant or sophisticated allocators looking for access in these kind of 4 or 5 names.
And I mean, it does make sense to want to get access to a category winner, at an attractive valuation when you see evidence of a liquidity or an IPO coming up. To be clear, that makes sense. We have exposure to some of these companies in different ways. I think it's how you go about getting that and making sure you're working with, a reputable partner. I mean, one of the simplest ways is just ensuring that that person actually has that capacity and you have the ability to look through to the underlying portfolio, and you've got to read, the LPA. You've seen opportunities where people don't even look at the LPA or the PPM or understand what's in there. So understanding what you own is super, super critical. And if you or your advisor doesn't, then that's probably not the approach that you should be utilizing to get access to private markets, right? It's not going direct. It's maybe working with somebody to build that exposure for you. So we have a checklist, like we have a DDQ, how to do DDQ. It's 20 pages or whatever with all kinds of questions that people should ask, but just ensuring that it makes sense. I mean, and you can discard some of this pretty quickly. Like a tool that I just use is I look at my LinkedIn network. At this point, I've got 10,000, 11,000 connections. If the person touting their access has no connections in common, that's probably a pretty good sign that that's made up. When I see somebody that's got 500 connections and I look at those connections really quickly and it's all credible VCs or LPs or PEGPs, that looks a lot more reasonable. So
this is a very tangible example of something I know you are an expert at. This just general trend of private markets moving into the wealth channel. Apart from best practices in how to vet these SPVs, any other sort of trends you're seeing or advice you would have for people who are new to allocating in this asset class?
Yeah, I mean, broadly the democratization of alternatives, I think it's a very good thing. When you think about like in feudal Europe, right, you couldn't own land unless you came from landed gentry, which was a heritable right. Like it didn't matter how much money you had, it had to be passed down. And for the longest time, private markets in the United States have had an asset test where you were prohibited from owning private equity unless you were a QP or accredited investor. And while there's reasons why that's meant to protect people, like it also just limits what they could participate in. So to me, that's always felt, and there was times when I was not an accredited investor myself and had been doing this for a long time. And so I couldn't invest, but somebody that inherited a ton of money and might not have known was able to. So I think like a level of sophistication is probably more important than a pure asset test, but like democratization done right, it's intended to open up the aperture of investors who can participate in, historically what have been very strong performing asset classes, private equity, venture capital, et cetera. Whether you agree with it or not, if you just look at like the top 100 pensions in the United States, the best performing asset for like 99% of them who've invested in has been private equity. So making sure people can participate, done poorly, right, is just opening the aperture for more sales. And certainly everyone wants to grow their business. You need to grow their business. There's benefits of scale, but I think done right, the whole goal is to take really skillful allocation and make that available to retail investors. So I think there's wrappers that we can talk about that are important and that broaden that ease of use. If you look at, this is maybe not the greatest analogy, or maybe everyone doesn't agree with it, but I think if you look at indexation, there's some interesting characteristics that are relevant for private markets. What has indexing done for public stocks? Well, it's made it cheap, it's made it scalable, it's given you broad diversified access, kind of in a one-stop solution. And when done right, I think private credit, certainly private equity, provides some of the same things. And so structures where you get broad access to drivers of return that continue to outperform, hopefully, ideally, and you do it in a way where it's relatively cheap. I mean, private markets are still going to be more expensive than public markets, but where scale can accrue and discounts can accrue to the end clients, that's a good thing. And then making minimums relatively low. So like very low minimums, low accreditation requirement. That to me is like the whole basis for why democratization should happen. So I think that's not one tool, that's not one solution, that's not one wrapper, but that's an evolution of a bunch of things.
It's so fascinating that you are not seeing like flames and fire in private credit. Can we just ask you a little bit about that finding?
So private credit has raised a ton of money in the last decade, but everything has. If you look at private credit compared to the size of private equity or other private credit markets, it doesn't appear to be massively overcapitalized, right? It's $2 trillion, high yields, call it $2 trillion. Bank loans are right around $2 trillion. Private equity's $6 or $7 trillion. So it doesn't seem to be like hugely overcapitalized. It's grown. Now, I like to say private markets are not one thing. Private credit is certainly not one thing. There's direct lending. There's all sorts of other stuff. That addressable market is multiple times probably of the corporate lending market. And even within the corporate lending market, there's mega deals, there's large deals, there's mid-market deals, there's small market deals. It's not all impacted the same. And so when we look through, we have seen evidence of spread tightening. We've seen evidence of credit underwriting standards eroding a little bit. So weaker documentation, weaker credit protections. But we also track 60,000 credits in real time. And we just haven't seen like massive defaults. We haven't seen, EBITDA falling off a cliff. We haven't seen coverage ratios completely dry up. In fact, in the last 3 years, we've seen interest coverage ratios pretty broadly improved.
Wow.
So yes, there are going to be defaults. This is not a zero default asset class. You should think of it more like high yield or bank loans. But we don't see this impending, 20% of the market is going to default. Like some of the headlines have been bordering on absurd. I mean, what we've seen has been lots less than that. So again, just being data driven and empirical and saying, yes, there's going to be pockets of risk.
Yeah, I think over the last 5 years, each asset class has done kind of the Spider-Man meme and pointed at the other, saying like, you're the cause of everything, or we're more well off than you. And it's kind of jumped from, venture being the redheaded stepchild to then like, credit to then even private equity having some real challenges. I think what we can all agree on is that the zero interest rate period had real impact on all of the different private market asset classes.
Mm-hmm. I mean, it created capital misallocation. I mean, that's what happens when you fiddle with the price of money. You're going to create capital misallocation. So that takes time to correct. I wouldn't say it's like perfectly corrected. I think one of the results we're seeing in private credit is that, like, as a result of some of these outflows and the stress in the market, we've seen underwriting standards improve. And so, the market has been adjusting. It takes a little bit longer in venture. It takes a little bit longer in private equity. But we've definitely seen the impacts of that. Valuations have, reset. Buyer-seller expectations are closer. Capital structures have rationalized a bit. So, yeah, it feels like things are healthier than the most, ardent critics of the space sort of want you to believe.
Yeah.
I think the other thing, like just in private markets, and like this is something that I want to convey to like new allocators to the space, RIAs, is like you can be a little opportunistic, but I really cringe when people want to be tactical. Like venture capital, private equity, private credit, private real assets. These are strategic decisions, and you are investing in them for, decades, but certainly 5 to 10 years minimum. And so you shouldn't be really like quarterly thing. Like you set a plan, right? You find managers and partners and advisors to work with. You commit those allocations, and you have to give it time to work.
I love that. That's the great advice.
Is there a private markets product or structure that you are seeing out there that makes sense, that you're sort of bullish on?
I'm going to talk my own book, so you have to discount this by that. But I think interval funds make a lot of sense, and for some of the reasons that we already talked about, like index funds. But just from an ease of client use perspective, putting my advisor hat on, what I realized is the difference between anything that requires a subscription and like a tender offer fund being one, an interval fund that looks and feels like a mutual fund. For an advisor, that's the difference between what we would call advisory and discretionary, right? One, you're giving a recommendation. The other, you can execute on it. So if you've got a mutual fund, you can just go buy it in a client's account. If you have to send them a subscription, that's a whole nother step. And it's not just like the advisors trying to be lazy. Like clients hate signing things. And so like if you get a new custodian or you got to change accounts, open a new account, fill out a subscription document, most clients are like, what am I signing now? We got to talk about this. Like, why can't you just do this for me? So anything that has ticker symbols that trades and looks, and by the way, ETFs can do this, but like feels like a mutual fund, is I think going to get more adoption from the wealth community because it just is easier to use. It meets their needs, whereas other things don't quite as much. So now, not everything fits in that. Like, I'd be first to raise my hand and say, like, venture's tough to do in that. If you've got 10-year, 12-year, 15-year sort of hold period things coming up with quarterly or semi-annual liquidity, probably doesn't work. I think PE can, and we have things in place that I think works. But just the structure itself, to me, and I think that's why you're seeing more adoption. If you look at evergreen vehicles, where's the growth the fastest? It's in it's in the interval fund segment of the evergreen universe. But there's not going to be one answer, because the diversity of individual clients and the advisors that serve them is far greater than what you see in the institutional community. And so because of that, there's a lot more different tools in the toolkit needed to build out those platforms.
And is that something you think was going to continue as the kind of RIA landscape matures in the private asset classes, and there's more consolidation? You think they're going to be looking for products like that?
I think the need for different tools is a permanent feature of wealth. And whether it's broker dealers, massive independents, small independents, like, there's a very broad, diverse universe there. And like, part of it is just driven by what the end clients want. Like, not every client wants to be serviced by a massive bank or a $400 billion wealth management platform. Like, to be clear, some legitimately prefer $1 billion, $2 billion boutique sort of local advisor that they can work with directly. So that market, yes, consolidation is happening. I don't think it stops. There's benefits from scale, like I said, but that segment of the market will also always be there. So tools and products and wrappers and access points to accommodate everything. And even, like, if you consider one big advisor, right, they're going to have different types of clients. Like, you may focus on mass affluent and have $1 million average client. You're inevitably going to have a 10 or a $20 million client. Vice versa, if you're ultra high net worth focused, like, it makes sense to take, the kids or Gen 3 or Gen 4 of a family who don't have the same liquidity as the bigger clients, and then you need tools to support their portfolio construction. So again, I harp on this a lot, but I think it's so true. Like, you need so many different tools available to build alts across the wealth ecosystem. That just isn't the case in the institutional world.
How do you recommend structuring venture to fit into that universe?
Well, if I had the perfect answer, I'd be building a product. I think, but I
Ernest
don't know.
And I can help you sell it, Chris.
I don't know. I mean, I think it's tough. You want, it depends if you want early stage or later stage, how proximal you are to sort of a liquidity event. But I think truthfully, like, it doesn't work inside of a lot of the fund wrappers. So you've seen a few tender offer funds which have less liquidity and they can kind of gate with broader discretion. And you've also seen some traded products that kind of look and feel like ETFs or closed-end funds. Maybe that works. I think time will tell. But yeah, it's a good question. That's the one that I don't think has been solved conclusively yet.
Chris, something you mentioned a few questions ago was about how, when you were talking about credit, not every credit deal is created equal, right? And there's different levels and different types, right? Mm-hmm. We're seeing that in all kind of asset classes and private markets as they mature. Do you believe venture is really being seen in that light when there are distinct different products, but it seems like everything from my perspective is just is kind of judged in a monoculture of criteria?
Yeah, I mean, I would say it is the same in the sense that it's not the same. Like, if you put one lens on VC and think of it all the same, that's very silly. If you look like what's happening right now, I think actually seed stage is probably one of the most attractive points. Maybe early A, pre-seed looks like it's a little bit competitive again, and the late stage stuff has been very aggressively priced. And so you see, like, valuations there have kind of exceeded what you saw in the 21 peak. And so it zigs and zags at different points in time. But certainly, like, even the hold periods, a seed stage deal is not going to work inside of a 5 or 10 year sort of drawdown. If you're doing pre-IPO or late stage stuff, that's that is very different. And so, yeah, it feels like if anything, the one area where you need to discriminate the most is probably VC. I mean, credit, closer, private equity, there's still differences between large deals, small deals, kind of what stage, the hold is, but venture is probably the most differentiated. So again, it feels to me like we've seen more of the product development occur at the later stage stuff because that's, again, a closer pathway to sort of exit. There's more liquidity available on the buy as well. So, but yeah, figuring out a way to get earlier stage primary capital formation into the hands of wealth investors, if you could crack that nut, I think you've got a good product.
At Aksia, you have so much cool data and research backward looking. What's in your crystal ball? What would Chris see in the future as related to venture?
Related to venture specifically, I don't know. I don't know. I think I think that you have to have, Earnest thinks that sourcing is commoditized, and to an extent it is, but I think you still need an advantage there. And I think one of the ways you can get an advantage is by deep technical expertise and domain expertise. So, I mean, you've seen it in private equity too, where sector specialism is leading to excess returns. I think right now, like technical team who likes to focus on technical founders, obviously you got to commercialize it, but at the earlier stage, more and more important. So I've sort of gravitated just personally to that. I'm an advisor to a firm that looks at a lot of stuff like that, has some good success there. So I find that just personally super interesting. You see stuff like quantum computing coming, and ultimately I think quantum will be more totally transformational than AI is. I think like actually to fulfill the promise of AI, you probably need quantum computing. Wouldn't pretend to understand it, but kind of. And so like I think I'm bullish on that. We might not be at a point yet where it's totally commercializable, and so investments today might not, but I think we're getting closer and closer. So that's one area that I would spend time.
A less of a kind of like future crystal ball. What do you believe is going to happen after kind of the IPOs happen in the foreseeable future, 18 months, and how that's going to impact the private markets?
I honestly have no idea. I'm not going to pretend to have a crystal ball for that. I think you just look at the size of it, it's staggering, right? I mean, I think these 3 IPOs that are slated to go out are the size of the entire .com IPO market. And there's something like half of all IPO volumes since like 1940 or 1950. That's an enormous amount of capital formation and really, really high valuation. So I don't know. I think one thing that I am curious about is for some of the businesses, like let's focus on like enterprise AI type stuff. Right, like the cost to compute for that is something like 10x what the revenue is for it. That doesn't work forever. Like I know the Amazon model, like that's, grab market share. You can give up profits while you're growing and building. That works. So, I mean, I don't want to be skeptical of it, but again, I think that what you'll see is that those prices are a very good exit for a lot of people that had owned it in the private markets. And I think that's kind of what IPOs are increasingly, right? They're more of an exit, and more of the growth and the capital formation has already occurred in private markets. So back to our earlier conversation, like on the SPV sales, like, right, it makes sense to try to get it where you can before that actually happens, because that's going to be the exit.
You want to be on, it's like you want to be on the early side of the SPAC.
I mean, you reach a stage in your career where things kind of look and feel like the greater fool argument, and you don't ever want to necessarily knowingly just participate in that, but you certainly don't want to be on the wrong side of it.
Yeah, arguably, even the people buying these SPVs they may have cusped onto the foolish end.
If you hear a lot of the rationale for why they want that, I mean, yes, some are sophisticated. There's family offices that know what they're doing. They're building portfolios, but a lot of them are just like, well, we know it's going to IPO at X. Mm-hmm. And you don't know that. I mean, it probably will, but you don't actually know that. So I think there's expectations that aren't always fulfilled. And if even the later people to the game are betting on that happening, like, well, that really needs to happen. So it doesn't feel like the best bet.
I think as a last question that would be helpful, I always get great insights from you, not only as like from your allocator seat, but then just as an investor and somebody who's constantly thinking about what's next and how that impacts you as a business professional. For any people that are new to the asset class or even young investment professionals, what skills would you suggest that they start to like really build and compound on?
I'm not the only one that says this. I mean, I've heard it from a lot of people, but I think one thing that AI will make more important is the importance of relationships and building networks. I have 2 teenagers, one in college, one not. So I'm thinking about what should they be doing and what advice should I give them? And they're going to do what they're going to do, regardless of what dad suggests.
Speaking of getting in touch, what's the best place to read what you're writing, find what you're publishing?
Sure. Well, I have a blog on LinkedIn that's called Alternatively Speaking. So you can subscribe to that and get my monthly insights. And we have a website called AC Private Markets, where all of our research is posted on the research page, so you can access that as well.
Fantastic. I highly recommend it. Following Chris is a must.
Oh, thank you. I appreciate that.
Thanks for being here, Chris.
Well, thanks for having
Chris.
me, guys. Yeah, it's good to be back.
See you later, allocator.
After Portfolio Tile, investing with a smile.